Hi everybody, that's Wednesday, March 26, 2025, and let's look for order block model for today's day. We're gonna start from monthly time frame. This is how it looks on monthly. Let's go down to weekly. This is how it looks on weekly. Price rejected from this volume imbalance. Let's go down to daily. On daily, price went to the consequent encroachment, which was mentioned when I was reading the weekly bias, and rejected, delivered perfectly. You want to study those examples. This situation happens oftentimes, and this is, for me, it's called the reversal sign. When the opening price is lower than the previous close, and we take the previous day high, there is a big chance of reversal. Let's go down to 4-hour time frame. Besides that, you can see that on 4-hour time frame we took the spin candle liquidity, which is beautiful, and this is consequent encroachment of that wick from daily. Then on hourly time frame, what do we see? That's right, we see that gap. You want to mark it. That's plus flat candle liquidity. Flat candle, okay. Where is that flat candle? Here you are. Down to 15. On 15, you want to see the 9:30 opening, you want to see 8:30 opening, and you want to see midnight opening. This is how it looks. Let's go down to, I want you to pay attention that there were these two relative equal highs. We have acceleration to the upside, 3 drives higher, 1, 2, 3. Displacement to the downside. Let's go down to 5-minute time frame. Look, all of those up close candles take this relative equal highs. Relative equal highs, liquidity being taken. Then once price reaches this opening price, we have order block confirmation, bearish order block. And yeah, this is where you could be entering. That's where the market opened at 9:30, but if you were in front of PC at 8:30, you could get the position somewhere over here or later on over here, okay? And yeah, let's take the projections, standard deviations from the lowest point to the highest point. And I want you to know this in your study journal. Oftentimes, right after price reaches 2 standard deviation from the order block, it comes back inside this order block. What does it mean for us? If you got in, let's say, here or here, and you're targeting 2 standard deviations, we should be going together with some liquidity, and here you see, let's take this relative equal loss, okay, on 5-minute time frame. If you were targeting 2 standard deviation and relative equal loss over here, then once price has reached the target, you can enter again from here and targeting already 4 standard deviation, because this is the pattern which repeats itself oftentimes. After price reaching 2 standard deviation, if it comes back inside a bullish order block or bearish order block in this case, it oftentimes goes then to 2 obviously, and again 4 standard deviations. And yeah, let's take a look how it looks in terms of risk reward. If you were entering, let's say, 3 ticks lower from the order block, and this is how it looks. If you go just for 2 standard deviation and this liquidity, it would be 1 to 192, or if you were targeting 4 standard deviation, that would be 1 to 4.28. And the very, very important thing is that we had the gap over here and flat candle. That's very strong target. If you were targeting this low, I'm not saying you're gonna learn to do this like instantly, but slowly, step by step, once you see once you understand fractal nature of the markets, of the time frames, you will be able eventually to get moves like this. Beautiful, isn't it? So hopefully you found this insightful, and until I talk to you next time, be well, all the best, and take care. Wow, what you just learned here could change the whole approach to trading. Are you ready to take the next step? Your next big insight is just one click away.